Hey up trades! I wanted to do a video analysis update of the stock market, but really just one aspect of the stock market, and it's really more of a, esoteric kind of woo-woo aspect of the stock market, kind of like how there's corrections around the fall equinox and the March equinox in the spring, one of those occult things. I want to do a little bit of a tutorial on kind of an occult aspect of the stock market. Of course, I'm talking about Elliott Wave, which gets a lot of its methodology from sacred geometry, kind of this universal mathematical, patterns that we see from seashells to nebulas to, the inside of a tree or whatever. Okay, but anyway, one of these aspects of Elliott Wave that you can see right here is an A, B, C correction. So the whole shebang of Elliott Wave is, me. I'm looking for 5 waves up. 1, 2, 3, 4, 5 waves up. Ideally, when 5 waves up are made, I can clearly see 5 waves subdivision on the RSI. And generally, what I mean by that is I have 1, 2, and then wave 3 on the RSI makes the highest high. So I like to stick with the weekly time frame, the daily and the monthly. If that's the time frame I'm focusing on, work too. But the wave 3 makes the highest high on the RSI. Wave 4, there's the shallow wave 4 correction, and wave 5 ends with momentum divergence on the RSI. It makes a lower high on the RSI, a higher high in price. Anyway, that's 5 waves up. What I want to focus on in this video is the 3 waves back, because this is actually one of the most useful aspects of Elliott Wave, and it's really the one that is probably most useful for risk management. So there's a few tricks to this. We're gonna get into my little bag of tricks here, but we're really just gonna talk about how wave theorists, how esoteric, voodoo woo-woo wave theorists like me, right, use ABC corrections to define risk in the stock market. So, of course, that's not all risk management comes down to, but some folk, I prefer, using a variety of risk management methods, options that give me unlimited downside exposure to the market, covered call ETFs, ETFs that sell puts on, the market, QQQY and JEPY with some interesting announcements today. But I want to talk about the stop loss aspect of risk management. I'm going to go through the S&P, the NASDAQ, the Russell. I think I'm going to do ROKU, Oracle, and Bitcoin too. And we're just going to see what kind of this rule is. So for an ABC correction, the general rule is I'm looking for a 3 waves pullback. So I'm really just looking for a 3 waves pullback, and kind of get used to seeing it after a while. I think a 3 waves pullback is just kind of dramatic, and it's kind of pretty. I don't know, like you can just kind of see after a while. You get used to seeing these ABC corrections, and I think that's what this is in the short term. So I can't tell my broker that I'm just used to seeing ABC corrections. But for wave theorists, we're going to get into some of these rules. So wave A is this initial wave. Some people really like to get into, is wave A 5 waves? Is it 3 waves? There's a 5-3-5. There's a 3-3-5. And there's a 3-3-3. That's all just technical jargon. I've never really found too much of that useful. Anyway, I want to just focus on the ABC corrections for now. There's this initial wave down, right? And remember, this can work the other way too for bears, right? Bears could have said this is wave A, this is wave B, and so they were looking for wave C to end right there, right? They would have been right, and they could have had a stop loss at the 127.2% extension, which is about 498. They could have said this is wave A, this is wave B, that's wave C. They're looking for a reaction, should they have been around to do that. Anyway, we're going to talk about kind of how just the general rule of thumb when 3 waves are identified. That kind of You know, I guess that's a little advanced, but I think that's one of the more, common things. Looking for, a 3 waves pullback within a broader uptrend, right? And so this can actually help debate, for bears if we are in a broader uptrend. We'll get into that later. But the whole idea is that I'm going to go to bar chart under my tools, and I'm going to get my fib extensions. I'm not going to get my fib retracements. I'm going to click and hold at the top of where I think wave A begins, and I'm going to drag down to the bottom of wave A. Then I'm going to release, and I'm going to drag back up to the top of wave B. So that's going to give me something that looks like this on these tools. The numbers aren't going to be perfect, but that's okay. So I can see the very top is 459.44. So 459.44, I'll see a number pretty close. I'll just go make it perfect. This wave A ended at 433.01, and wave B ended at 453.67. 433.01, and this was 453.67. So the rule of this, and it's Elliott Wave theory, the rule of this goes something like this. And I think it's useful to think about the beta and the volatility of the stock. So if the S&P 500, that's always that's generally always the base for volatility, right? So anything that's more volatile than SPY, especially if it's a lot more volatile than SPY, I would take that into account. But generally, if something is just about as volatile as SPY, I'm looking for an ABC correction to end around where the length of wave A places the wave B high is where wave C ends. So that's what you guys will see me doing on my charts, where I've got wave A, wave B, wave C. Now, to get it a little more precise, wave A, wave B, wave C is going to give what some people call a box. I guess it technically can just be called a box, but it's going to give a buy zone, essentially. And this is called the box, and so this is A, B, C. The top of the box is the 100% extension. That's 127.27. The bottom of the box is this real important level right here, is the 161.8% extension. So that's really the most important level. And that's generally, if someone's using the ABC correction method, where they're just looking for an ABC, they're saying, hey, this wave C is going to end, and we're going to go make a new high within the impulse. They'll generally use the 161.8% extension as the stop. Now, if that does break using this method, what that is going to do is it's going to give credence to the bear argument that this isn't an ABC correction. It's a 1, wave 2, and if SPY went down below 410, if it impulsed down below 410, using this method, that would suggest this isn't actually an ABC correction. This is 1, 2, wave 3. That means this is an impulse from this high, right? And that's going to give credence to the larger bear argument that the larger bear argument is basically always going to be that we're going to crash and see SPY go to the 200s, just to be frank, right? The lower 300s would be their first target, right? But for identifying risk in an ABC correction, wave A, wave B, wave C, if wave C, the top of the box is the 100% extension, the bottom of the box is 410.91, and that's a place where if it's not great to buy, it's generally really bad to short. All right, that's not investment advice, but when people talk about shorting in the hole, if you've ever heard that term, wave theorists will, this is the hole in wave theory, essentially. And so at minimum, there should be a reaction, right? Even if someone was more bearish, they might say something like this. This is the first leg of wave A, so they're still looking for a reaction for wave B and then wave C down. That's called a double correction, 3-3-3, or actually that's called a 3-3-3, what some will refer to as a WXY. Again, more technical jargon. I wanted to focus on the ABC correction, wave A, wave C, wave B, top of the box, 100% extension, bottom of the box / the stop, And also the invalidation for this method, just this method, is 410.91. Now, realistically, what I like to do is I like to look at the broader count and see what I think is going on. So for SPY, I think this is a large ABC correction that ended. This is a wave 1 and a wave 2. This is another wave 1 and another wave 2. And this is a big wave 3. So this is wave 1 and wave 2. A large wave 3 is in progress. That's this black wave 3 up here. This is another wave 1 and another wave 2. So this is wave 3 of wave 3. This is an ABC correction ending wave 4 of wave 3. So wave 4, the 50% to 38.2% retracement is where I'm going to look for SPY, something as volatile as SPY to end. The 418.31 is that wave 1 high. I like to use that as a wave 4 invalidation. So that's focusing on the impulse. I wanted to focus on the corrections in this video. So just using the correction method, but that's also why, since I think it's a wave 4, there's kind of a confluence, right? It's between the 38.2 to 50% retracement of wave 3, which is where wave 4, is a good place for wave 4 to end. And it's also between the 100% to 161.8% extension of the length of wave A placed with wave B high being where wave C ends. So anyway, that's SPY. I think I covered the rule pretty clearly. So now I'm going to go a little faster with some of these. We're going to look at the NASDAQ. I actually don't think the NASDAQ has reached this ABC correction. I'll talk about, I don't think it has. So the NASDAQ, to my knowledge, has not gone the length of wave A placed at the wave B high being where wave C ends. Okay, so there's a few ways to look at this. Let's just look at the bigger count. I'll tell you guys what I think, and I'll just erase this for now. What I think is going on in the NASDAQ in the big picture is that from this low, this is a wave 1 and a wave 2. That means this is either a large wave 3 and a wave 4, or it's another wave 1 and another wave 2. The reason that I say that is because this is wave 1 and wave 2. This is a large wave 3, and one justification that it's a wave 3, like I said earlier, if it goes past the 161.8% extension, that's going to give credence to the idea that this isn't A, B, C. It's 1, 2, 3. We're in an impulsive structure. Okay. Anyway, like I said, I wanted to focus on the ABC corrections. So from this high, what's really important is that this is an ABC correction. And just while we're on the subject of ABC corrections, look how perfect this one was. A, B, C. Perfect. Right there in the box. Right there in that hot zone, that big reaction holds. For these big weekly counts, I think the 127.2% extension can be useful because the 161.8% extension is pretty far. That's a good example of why this is important to pay attention to. One, and why I draw these lines, and why they think they're silly. Well, it's not silly when the NASDAQ rallies 30-40% and people start talking about AI computers. 1, 2, 1, 2, just like SPY, I think. So this is wave 3 of wave 3. Wave 4, we're not at the 38.2% retracement. So right now, this is looking at like a shallow wave 4 to end for QQQ. I'll get into the reasoning with some semiconductors in a second, why I think that might be justified. But I want to get to a 1, 2, 1, 2, wave 3 of wave 3, a shallow wave 4 ends. The most useful stop right now for QQQ, the 38.2% retracement is 348.71. That's pretty tight, and it also wouldn't invalidate a wave 4. That'd actually be the ideal place for a wave 4 to end. I think 336.59 is a useful long-term invalidation, that 50% retracement. And then for, this rule right here, we don't have that the NASDAQ has gone and reached the length of wave A, placed with wave B high, where wave C ends. So this is something that I would look for if the market took another leg lower. That, okay, how's the NASDAQ going to react when it gets here, right? This is an ABC correction. I could go in and I could make the levels perfect if I wanted to. It would take, a little bit of time. But we haven't seen, let's just do it. 387.98. 387.98. This is 354.71. and this is 380.83. So we have not seen wave C go the length of wave A, place of the wave B high, being where wave C ends. We have seen, however, a lot of semiconductors do this exact same thing. I just wanted to get into the kind of this rule for this video. So 347.56 is that magic 100% extension. The NASDAQ hasn't reached that yet. So if the market did take another low, this would be a place where I'm looking for, this is a big hole, to be shorting in. I would say SPY suggests it's already, a pretty big hole to be shorting in. I haven't even gotten into, other stocks in this video, but I didn't really plan on it. But from this low, I got this up recently. Tesla could be 1, 2, 3. That would be a little bit of evidence for the Qs. I wanted to stick to this ABC correction rule. You guys know I can get off topic. So I'm going to get to a pretty short-term count now. I focused on some weeklies with the Qs. I think the IWM, I'm going to do pretty small term daily, 179.63, 179.78. So just with this impulse, 1, 2, and then look at this. I don't know. We don't make we end this impulse with the highest high on the RSI, but look how it's just a very clean subdivision. I'll get to what I mean in a second. Wave 1, wave 2, I believe wave 3 is the biggest wave. Wave 4 retest perfectly the wave 1 high, and then wave 5 is a little shorter than wave 3. So wave 3 is the biggest wave. Wave 4 retest the wave 1 high. It looks like a pretty clear 5-wave subdivision. Now this rule, if there's a highest high on the RSI that a wave 5 hasn't occurred, what that really means is that a wave 5 hasn't occurred on the larger degree. So I'm going to label this as a wave 5, and I think a lot of my subscribers or followers would say, well, Pup, you say if there's a highest high on the RSI within wave 5, then a wave 5 hasn't occurred. So it's 1, 2, 3, 4, 5 waves up. The highest high is made on the RSI within wave 5. So I think that instead of that, while that says a wave 5 hasn't occurred, I think it means a wave 5 hasn't occurred on the larger degree. That means this isn't a large wave 5 that's occurred. I think it's a large wave 1. That might have been a little confusing, but basically there's a clear 5-wave subdivision, in my opinion, for IWM. The RSI makes the highest high, suggesting from this low, this isn't a big wave 5. That doesn't really, that's kind of silly for IWM because I don't think anyone would have said this is a wave 5 anyway. But that's a, example of, using the RSI to find a clear 5-wave subdivision, even though it's not perfect. I think that this does satisfy the other rules of the 5 waves impulse, where you have a 1, 2, wave 3 is the biggest wave, wave 4 retests the wave 1 high, wave 5, is, another impulse higher. It doesn't end with momentum divergence. I don't think it's a large wave 5 that occurred. I think it's a large wave 1 that occurred. So this is a great example of how useful this rule could be. 198.75, because wave theorists are looking at this chart differently than everyone else. I'll say what that means. This is where a lot of people are going to say, the Russell's weak, right? Losers chase losers. And what happened in 2020, I'll just say, is that it was a very similar situation going into the fourth quarter. The Russell lagged a lot. The S&P and the S&P and the NASDAQ, and a lot of people, a lot of bears who were really frustrated that they hadn't been, successful shorting the Qs and shorting the S&P, well, they started shorting the weak Russell. The problem was a lot of money was flowing into the weak Russell during that September correction, and they didn't find out about that until the first quarter. So I'll go ahead and make these different colors just so it's not confusing. But just sticking with this ABC correction idea for a sec, I'll go make these levels perfect, 198.75. And then this is, so what I'm doing here, this ABC correction, I believe, we're going to get a little technical. This ABC correction, I believe, if you look at this, some people might be nitpicking and say, Pup, why don't you have wave A ending here? I believe this is an ABC correction where the connector wave, wave B, takes the form of an expanded flat. So that's jargon, but I don't want people to think that I'm, just putting the lines where they fit. So, a lot of people probably think that anyway. So I think that this connector wave right here, this wave B, is taking the form of an expanded flat. Just since this is a wave tutorial video, I wanted to, make sure the perfectionists weren't going to be angry. Anyway, looking at IWM, this is one of those great examples of defining risk. There's a lot of ways to define risk right now, but I think this ABC correction one is the most useful. Length of wave A, place the wave B high, 100% extension has been hit. That 127.2% extension, I believe, is giving the most useful stop right now of 170.43. The invalidation for this all being a wave one is 167.46. And then bulls will look for the length of wave one, placed at the wave two low to begin a wave three for the Russell. So I'll make sure that's all, prettily labeled so it makes sense. That's wave one. This is wave two. And then this is wave three. So this is what the bulls are going to look for over 170 and 167. I wanted to show because it's one of those examples where other forms of TA aren't going to say, hey, this is the whole. And the thing is, even if this isn't correct, I hope I don't break anyone's brain with this, but even if this isn't correct, from an Elliott Wave standpoint, a wave theorist is still going to be looking for a bounce. In other words, even if this isn't the end of a big ABC correction, I think it'd be a little silly to say, but they say this is wave A, and they're still looking for a wave B counter trend rally before another leg lower. So that's why, that's kind of one of the things. Only a wave theorist is going to identify this as any sort of hole at all. Whether or not it's the super bottom or not, that's what the larger degrees are going to come into play for. But with the ABC corrections, when the three waves pullbacks happen, a lot of times while all the other forms of TA are crying, weakness, wave theory is saying, hey, this is the hole. And it goes the other way too, by the way. It goes the other way. Like I said, with the Qs and, this method would work going up too. Someone identified a clear, this would be a good example. Someone identified a clear, one wave up, two wave back, they're looking for that 100% extension to that 127.2% extension to be the hole that bulls don't want to buy in, right? So that they wouldn't, short in buy. Anyway, let's get into Oracle. Oracle 39.71. Oh man. Anyway, big picture view of Oracle. Like I said, just want to focus on these ABC corrections. I think this is I think the weekly is on. Yeah, okay. The weekly makes a lot prettier picture there. 127.20. Oh man. Okay, so Oracle. I think this is a large wave one and a large wave two. I think that's huge evidence for the software sector, by the way. Adobe, very similar thing. It looks like it's following Oracle now. But Microsoft also at an all-time high in the software sector. But just looking at this, we have this big, multi-month, over a year-long impulse and a correction to the 61.8% extension, and we've broken a new high. So this was a wave 1 and a wave 2, or it was a wave A and a wave B. We're within wave 3 or wave C now. So subdividing that wave is the task. I think it's pretty clear. This is 1, 2, wave 3. Look at that huge high, this big ass impulse on the RSI, massive weekly RSI thrust, highest high within this whole cycle. That's huge for wave theorists because that says this is not a large wave 5. It's as close as a wave theorist can get to, I hate saying this word, a guarantee that eventually Oracle is going to go make a new high because a wave 5 hasn't occurred. If you think that rule is silly, you probably shorted the semiconductors and NVIDIA because that's the exact same rule that was being used to look at this multi-year chart and say, hey, wait a minute, on the monthly chart, this is the highest RSI reading. Therefore, this is not a large wave 5 that has occurred. Therefore, it must be an ABC correction. It was. Anyway, back to Oracle and this ABC correction. But man, that wave 3, that's why I love making these videos, because I probably wouldn't have even noticed that if I didn't, make this. But anyway, just focusing on this ABC correction and defining risk. This is a huge chart for market bulls to look at. And remember, I use option straddles. I am mostly focused on selling premium and collecting dividends and reinvesting them, through ETFs. When I invest in growth, most of the growth I invest in, are paired with, yield max ETFs or covered call funds, or, even put selling funds now that are available on, growth indices and growth stocks. And that's kind of the relationship I, want to have with growth, is that I'm using the high volatility to get massive income. Right now, Amazon, AMZ is yielding about 27-30%. And it's got the same implied volatility as PayPal right now. And so I can get a massive amount of premium from AMZ, and I can blend it with Amazon. I'm essentially getting a 16 or 17% yield, holding Amazon, and I can reinvest dividends if it keeps falling. Anyway, that was sidetracked. Let's just get into this ABC correction for Oracle. It's a very useful one for defining risk. This high right here is 127.54. This high very close, 127.42. And then this was 111.13. So we're actually getting close to a hot zone for Oracle. They're making this one pretty tight. 100 right there is that 161.8% extension. So just using this method, bulls are going to look for Oracle to hold above 100, and this ABC correction is going to end. Now, I think there's a lot of evidence that even if 100 was broken, it wouldn't be, the end of the world for Oracle. Let's just, since this is the wave 4, another way to find levels, if it's getting really close, is that since the wave 4, the ideal levels is it ends at the 38.2 to 50% retracement. Now that can throw a lot of people off, because if it can definitely go deeper than that for a very volatile stock. And if it's not a volatile stock and it goes deeper than that, it could not be ending a wave 4. It could be ending a wave 2. So it's a nuance to wave theory, nuance to everything, in markets and really in life. But we've taken a lot of that out. Anyway, the 61.8% extension also lining up around that 100% level. So yeah, 99 to 100, very tight for Oracle. I'm looking for ABC correction to end. Like I said earlier, the wave 1 high of 91.22 would be a long-term invalidation. But I think this highest high reading on the RSI being where wave 3 ends is very telling that eventually Oracle is going to make a new high at some point, right? At some point, per Elliott Wave theory, I think that's what's going on. ROKU, there's a lot of things to say about Roku. I think I've made it pretty clear. I think the chart of ARC in holding, this low is pretty important. But Roku is giving a very useful, risk definition just for within this cycle from this low. It looks like, 1, 2, 3, 4, 5. Now, what's the problem with that? The problem with that is that wave 3 is the shortest wave, and that's not supposed to happen. In the big picture, I think this is wave 1 and wave 2. I think this is another wave 1 and another wave 2. I've talked about ARC is a reasoning why. I'm not going to get into ARC in this. I talked about it in my recent video, growth stock special. But just looking at Roku from this low, or from this high, this ABC correction rule, I think is going to be a very useful phenomenon right now. 95.73. Sorry, I'm going to make all these perfect. Some say you got to be neurotic about risk management. I don't want to glorify mental illness, but I think you got to be a little neurotic about risk management. You got to be a little neurotic to be a wave theorist. And, I like to get it perfect. 98.44. 75.12. And this is one of the benefits of wave theory when, this much, it's this. I'm not saying the predictions are precise, but I'm saying the kind of diagramming, the charts and the very exact measurements of, where the waves are ending and where the retracements are supposed to be, is an advantage that wave theorists have. Anyway, from this high, this ABC correction rule, very useful, where only wave theorists are going to say, hey, wait a minute, I think that's the hole. I'm not sure, in the long term, this be a good place to short. As far as buying, the idea is something like this. This is wave A, this is wave B. The top of the box, so the box is a little big, but the top of the box is that 100% extension. Bottom of the box, 58.11. That'd be a nice invalidation. A, B, C. So if it goes below 58.11, that would give credence to, let's just say, I think I've made it pretty clear. Above 58.11, this correction ends. Roku does very silly things, right? So what if that doesn't happen? Let's talk about what if Roku went below the 161.8% extension. Let's be a little fair to the bears. What that would mean is something like this, right? So Roku, what I said at the beginning of the video, the more volatile the stock, the more that 161.8% extension break has an asterisk by it. But let's say Roku did go down and went below 58.11. Let's say it went below 58. It really broke 58. That would give credence to the bear argument that this is not an ABC correction. It's 1, 2, 3, 4, 5 waves down, right? So I just wanted to show what the, other scenarios would be. I've talked about ARC, and the kind of how it's really defining risk a lot better than, or it's defining risk for the whole sector, I think quite well. But just looking at ARC, this is kind of probably the more useful invalidation. It went right down to the 78.6% retracement. Wave 1, wave 2. I think this is another wave 1, another wave 2. 34.72 was that invalidation for a nest. Probably going to be more useful than anything Roku gives. This isn't a whole market update video. This was just a little bit of a tutorial. Bitcoin, BITO. I'm in it. Look at this impulse. 1, 2, wave 3, wave 4, wave 5 ends with momentum divergence, ABC correction. That was a correct, indication that this correction was going to end. We were going to see impulse higher. So for Bitcoin, I'm going to focus on this count just within the cycle from the 310 low, wave 1, and this ABC correction is what I want to focus on. A, B, C correction for BITO. So it ended at the 78.6% retracement. That means the best invalidation is 12.06 for this nest view, that it's 1, 2, 1, 2, wave 3 of wave 3. It can't be a nest if it goes below 12.06. But as far as ending an ABC correction, it still could be ending an ABC correction. I just wanted to talk about these numbers with Bitcoin popular. instrument. So I'm going to measure this ABC correction, 11.90, a little further than 12.06, 10.33, very wide, not very useful. The high is 18.39. The low is 13.90. The high is 17.70. So that's where these numbers are going to come from. In this case, the 121 or the 127% extension is right around actually where the invalidation is of anyway of 12.06. So basically above 12.06. I'm going to keep holding, Bitcoin and BITO. If it went below that, I don't know if it'd be the end of the world, but that would probably, there's more to Bitcoin than just BITO. I think above 12 to 12.06 is a huge level, at least for me. I've been looking at Ethereum recently. I think Ethereum would also give additional levels for crypto. Looking at Ethereum, Jesus is outperforming, but just from this high, I think, just looking at Ethereum, I'll just go real quick. 1, 2, wave 3, highest high on the RSI, shallow wave 4, wave 5 that ends with momentum divergence, a wave 1, an ABC correction wave 2 at the 78.6% fib, so below 1372.941 will invalidate Ethereum entering wave 3 of wave 3 with Bitcoin, with BITO, and I expect, Ripple and the gang as well.